Welcome to the Physician's Guide to Financial Wellness, the podcast dedicated to helping physicians in Michigan turn their professional success into financial success while enjoying life along the way. And now, here are your hosts, Andrew Mushbaugh and Trent DeBruin.
Hi, everyone, and welcome to another episode of the Physician's Guide to Financial Wellness. This is Trent DeBruin, and I'm joined, as always, by my co-host, Andrew Mushbaugh. And today, we're going to dive a bit deeper into investing and talk about a strategy called asset location. So knowing that different investment accounts have different treatment for tax purposes, using asset location means being strategic about which investments you own in which specific accounts in order to maximize the overall tax efficiency of your investments. In other words, it's a way to reduce the amount of taxes you ultimately pay on your investments and improve your after-tax investment return, or the amount of money that ends up in your pocket and is available for you to spend, which is the investment return that truly matters. And while we normally tend to keep things higher level when talking about various financial planning topics, today we're going to go a bit more into the weeds, but we'll still try to keep it as straightforward as possible. So, Andrew, why don't you kick things off with an overview?
Sure. So the first and most important part of asset location is having enough cash stuffed under your mattress.
Well, I'm glad that priority trumps having enough gold bars stashed away in your bunker.
Yeah, well, that was going to be next. So outside of having enough cash under your mattress and gold bars in your bunker, we can move on to the other areas. And as Trent mentioned, asset location is being smart about which investments you own in which accounts. And a good way to think about it is like a puzzle, where you have one overall investment allocation that's right for your situation based on your goals. And that one allocation consists of several different pieces, such as U.S. stocks, international stocks, emerging market stocks, bonds, etc. Well, asset location is taking the different pieces and deciding where to place them to fit it all together into one overall picture. As we've talked about in prior episodes on investing, there are three basic types of buckets of investment accounts. One is PreTax Accounts, where the money grows tax deferred and you pay taxes down the road on each dollar you withdraw. And when you withdraw the money, you pay those taxes at ordinary income rates. The second type of account is the Roth Accounts, where the money grows tax-free and you never have to pay taxes when you eventually withdraw it. And the third account type is Taxable Accounts, also known as brokerage accounts. With taxable accounts, you pay taxes each year on any dividends and taxable interest from your investments. You'll also have to pay taxes on any investment gains when you sell the investments, although the gains are taxed at lower long-term capital gain rates if held for more than a year. So step one is understanding that each bucket or type of account is unique when it comes to its tax treatment. And step two is understanding that each different puzzle piece or investment, U.S. stocks, international stocks, bonds, etc., is unique when it comes to its tax efficiency. So the goal of asset location is to own your investments or puzzle pieces in the right buckets or account types based on the unique tax treatment and considerations. And the reason we're even talking about this is because when it comes to investing, if you want a better investment return, you almost always have to take on more risk to achieve it. So there's a tendency for risk and reward to be correlated. However, with asset location, it's one of the few ways to improve your investment return without actually taking on more risk. You're simply taking your existing investment allocation and being smart about how you hold it to maximize your after-tax return. And just to give you a sense of the potential benefit, various studies have been done to try and quantify the value. And those studies show that asset location has the potential to add around 0.25% per year, with some even suggesting that number could be as high as 0.75% per year. And while these numbers may or may not seem that high, depending on your experience with investing, you'd be amazed by how this difference can add up over time due to the power of compounding. As an example, let's say you had $500,000 in a pre-tax IRA and $500,000 in a taxable account, so $1 million in total, and are investing in a 50-50 portfolio of half stocks and half bonds. Let's also assume the stocks grow at an average of 10% per year, and the bonds grow at 5%. We'll also assume your ordinary income tax rate is 25%, and your long-term capital gains tax rate is 15%. We'll compare two scenarios to look at the growth of the accounts over a 30-year period and how much money you would have on an after-tax basis after withdrawing from the accounts. In scenario one, you hold all of the stocks in the IRA account, and in scenario two, you hold all of the bonds in the IRA account. Looking at scenario one, with all the stocks in the IRA, you would end up with a little over $8 million, while in scenario two, with all the stocks in the taxable account, you would end up with a little over $9.1 million. So in this very simplified example, that would mean a difference of over $1 million more in your pocket by simply being smart about where you choose to hold your different investments without even changing the actual investments themselves. Now, not every scenario is going to be as dramatic as this one, but it illustrates the point that depending on the nature of your situation, this can be low-hanging fruit in terms of an easy way to move the needle and improve your after-tax investment return. It's worth noting that how relevant asset location is for you will be determined by several factors like the types of accounts you have, your target investment allocation, the specific types of investments you own, and the value of your investments. On one hand, if the only investment account you have is a pre-tax 403(b) through your employer, and it's all invested in one global equity fund, then asset location isn't as relevant. However, on the other end of the spectrum, if you have a mix of pre-tax, Roth, and taxable accounts, and a diversified stock and bond target investment allocation with a mix of many different investment funds, then asset location will be significantly more relevant and potentially much more valuable as well. So our goal with today's discussion is to at least explain some of the key concepts so you can understand how asset location may or may not play a role in your investment plan. And on that note, we do want to provide the disclaimer that this discussion is for informational purposes only and does not represent personalized investment advice. Every person's situation is different, and what makes sense for one person might not make sense for another. So what we're sharing here are general rules of thumbs and the rationale behind them, but we know they may or may not make sense for you personally based on your unique situation, which is why we always recommend consulting with a qualified financial professional before implementing any strategies or ideas discussed. So with that fun disclaimer out of the way, Trent, why don't you start by tackling the first account type or bucket, Roth accounts?
Gotta love the compliance disclaimers. They really add a lot to the podcast.
Yeah, I just have to make sure I keep my chief compliance officer happy.
Yeah, that's right. I'm glad you recognize that. So starting with Roth accounts, as Andrew mentioned, these are accounts where you contribute the money initially and don't receive a tax deduction for your contributions. But once the money's in the account, it grows tax-free and you never have to pay taxes on it again when you withdraw it in the future. The most common type of Roth account is a Roth IRA. So perhaps you have one from making direct or backdoor Roth IRA contributions throughout the years, or from rolling over Roth money from an employer retirement account. Or maybe you still have Roth money in an employer retirement account from making Roth contributions to a 401k, 403b, or 457b. Regardless of how it got there, it's nice to have money in a Roth account because of that tax treatment and knowing the money will never be taxed again. And from an asset location perspective, knowing that you won't have to pay taxes on Roth money from year to year, and you also won't pay taxes on the growth of that money when you withdraw it in the future, in your Roth accounts, you want to own your high growth, tax inefficient investments. So these are the investments that you expect to have the highest returns over time, to grow the most, and also aren't very tax efficient year in and year out in terms of the nature of the investments. So just as an example, one of the cardinal rules of asset location is that assuming your target investment allocation consists of a mix of stocks and bonds, you want to avoid holding bonds in your Roth accounts and instead own stocks in them. And just to clarify, when we say stocks and bonds, we don't necessarily mean individual stocks and bonds, although it's certainly possible to own individual stocks and individual bonds, but we mean any investment that falls into either category, such as ETFs or mutual funds that own underlying stocks or bonds. And the rationale for favoring stocks over bonds in Roth accounts comes back to the difference in expected returns for the two types of investments. As we've discussed in prior podcast episodes, stocks have historically had much higher returns than bonds, around 10 to 11% per year on average, compared to around 4 or 5% for bonds, because stocks are riskier investments. And while there's no guarantee that future returns will be similar to historical returns, it's reasonable to expect that over long periods of time, stocks will continue to have higher returns than bonds due to their higher risk. So knowing that you'll never pay taxes on the growth of investments held in Roth accounts, if you expect stocks to grow more than bonds over time, you want to hold the stocks in your Roth accounts because you'll never pay taxes on that growth. So owning stocks rather than bonds in Roth accounts is step one and the low-hanging fruit of the Roth account asset allocation. Step two is looking at the specific types of stock investments you own and being smart about which ones you hold. As mentioned, Roth accounts are where you want to own your high growth and tax inefficient investments. So when thinking about which stock investments to hold there, you want to find those that ideally check both of those boxes. And we won't go too far into the weeds breaking down the specific subtypes of investments, but emerging market stocks tend to stand out as a stock investment that has high expected growth and is also fairly tax inefficient. Another example is stocks that have a high expected return, but where that return doesn't come solely from the price of the investment increasing, but instead from a mix of the price increasing plus quarterly or annual payments to investors in the form of dividends, which are taxable to you as an investor. Historically, growth companies have reinvested more of their profits into growth of the company, while value companies have paid out more of their profits to investors in the form of dividends. So keep in mind this potential difference in the nature of different types of stock investments and how your expected return as an investor is composed. So stepping back and summing it up, when you look at the global stock market as a whole, there are certain areas that tend to be more tax efficient and other areas that tend to be less tax efficient. So if you own a globally diversified investment portfolio with a mix of different stock investments, US, international, emerging markets, small, large, growth value, etc., you want to think about which accounts you place each of those different stock pieces of your investment puzzle. So that's an overview of Roth accounts. And now, Andrew, why don't you cover the next bucket or account type, which is pre-tax accounts?
Sure. So pre-tax accounts tend to be the largest bucket, or the accounts with the most money for most people. And the reason why is that employer retirement accounts tend to be the biggest retirement savings vehicle for people. And the reason why pre-tax accounts tend to be larger than Roth accounts is because most people are in a higher tax bracket during their working years relative to retirement. So they prefer to receive tax deductions along the way, which means making pre-tax rather than Roth contributions to their employer retirement plans. So your pre-tax accounts might be pre-tax 401ks, 403bs, or 457bs through your employer, SEP IRAs, individual 401ks, or simple IRAs if you're self-employed, or traditional or rollover IRAs if you're retired and you consolidated your old employer retirement accounts. I know it's an alphabet soup of acronyms there, but the most basic level, the way pre-tax accounts are treated for tax purposes, is that when you contribute money to the account, you receive a tax deduction. And once the money is in the account, it grows tax deferred, which means you don't have to pay any taxes year to year on dividends, interest, or when you sell investments in the account. Then in retirement, or when you eventually withdraw from the pre-tax account, you pay the taxes. And you pay taxes on each dollar you withdraw at ordinary income rates, which are higher than long-term capital gains tax rates. Because of this taxation, you generally want to own your investments that are tax inefficient and have expected returns that aren't as high as the investments that you hold in your Roth accounts, which, as Trent just mentioned, is where you want to own your tax inefficient investments that are expected to grow the most over time. And looking at investments that are tax inefficient, you want to understand how the investment generates return for you over time. For stocks, most of the return comes from the growth of the investment itself, aka the price going from $10 to $100, versus the quarterly dividends it kicks off. Whereas other investments, like bonds or real estate funds, tend to have a higher percentage of their return derived from the interest paid over time or their distributions. So understanding how a particular investment generates return for you allows you to compare the tax treatment across funds. And as I just mentioned, a larger percentage of a bond's investment's total return comes from the interest it pays, which is taxable interest. So this is a clear example of an investment that would benefit from the tax-deferred or tax-free growth of a pre-tax account. For bonds with taxable interest, such as government bonds or corporate bonds, each year they pay out a certain amount of money to the people who own them, and this money or interest is treated as ordinary income for tax purposes. If you held these bonds in a taxable investment account, each dollar of interest would be taxed at your ordinary income tax rate each year, so you'd end up paying a lot more of taxes over time. However, if you held those bonds in a pre-tax account, you would avoid paying taxes on that interest each year. As a quick side note here, it's worth mentioning that there are some bonds, like municipal bonds, that have tax-free interest, which allows you to own them in a taxable account while avoiding paying taxes on the interest along the way, which Trent will discuss next. So it's not like you should only ever own bonds in your IRA, but for the purpose of our discussion here, the idea is to own the tax-inefficient investments in your IRA. So if part of your target investment allocation includes bonds that pay taxable interest or other tax-inefficient investments like REITs or value stocks, it's generally a good idea to hold these investments in your pre-tax accounts. And bigger picture, to recap the Roth and pre-tax buckets, it's usually helpful to follow a process or waterfall of filling the different buckets before moving on to the next one. So step 1 is filling your Roth bucket with the investments that have the highest expected growth. And step 2 is looking at your pre-tax bucket to fill it with whatever is left over and targeting your most tax inefficient investments in the process.
Now we'll move on to the last account type, which is taxable accounts. The way these accounts work is that you pay taxes on dividends and interest kicked off by your investments each year. And when you eventually sell investments, you pay taxes on the gains, or the difference between what you bought and sold the investment for. If the investments were held for more than a year, those gains are taxed at long-term capital gains tax rates, which are lower. While if you held those investments for less than a year, you'd pay taxes on the gains at ordinary income rates, which are higher. And just to quantify things a bit with the tax rates, for a married couple filing taxes jointly in 2022, the long-term capital gains tax rate is 15% if taxable income for the household is anywhere from around $83,000 to $517,000. Once above $517,000, the long-term capital gains tax rate maxes out at 20%. Although it's also worth mentioning that there's a 3.8% net investment income tax on capital gains if household income is above $250,000, so you'd have to add that in as well if it's relevant for you. For ordinary income tax rates, on the other hand, the rate is 24% if household income is between $178,000 and $340,000, 32% from $340,000 to $432,000, 35% from $432,000 to $648,000, and it maxes out at 37% above $648,000. The 3.8% net investment income tax also applies to dividends and interest if household income is above $250,000. So as you can see, for most higher income households, ordinary income tax rates are substantially higher than long-term capital gains tax rates. And to provide a little more color on dividends and interest, this is money paid out by the investment to the owner of the investment. So for interest, if you own a bond fund that has a 3% interest rate, that investment would pay you 3% of its value each year in interest. If you own a stock fund that has a dividend yield of 2%, that investment would pay you 2% of its value each year in dividends. And the timing of interest and dividend payments varies, so while that 3% interest rate and 2% dividend yield are annualized, you might receive your interest and dividend payments quarterly or monthly instead. Knowing that taxable accounts are taxed this way, as a general rule of thumb, you want to own high growth and/or tax-efficient investments in your taxable accounts. So looking at stocks, one of the classic examples is a U.S. large cap index fund, such as an S&P 500 index fund, which tends to be tax efficient. There are also certain stock funds or ETFs that are specifically managed in a tax efficient way. Another example would be growth stocks, since, as mentioned earlier, they tend to reinvest more of their earnings into growth, so they pay out less money to shareholders in the form of dividends, and a greater portion of their investment return comes from an increase in the price of the investment, which, as just mentioned, this growth is taxed at a more favorable long-term capital gains tax rate if held for more than a year. On the other hand, stock investments that pay out a larger amount of dividends each year, such as value stocks with a high dividend yield or real estate investment trusts, which are also known as REITs, would be less attractive to hold in a taxable account. Switching gears to bonds, as Andrew just alluded to when talking about pre-tax accounts, if you have bonds as part of your investment allocation and plan to hold some of them in your taxable account, one thing to consider is owning municipal bonds in the taxable account. The reason for this is that the interest paid by municipal bonds is tax-free, so unlike the interest paid by corporate or government bonds, which is taxed at ordinary income rates, the taxation is more favorable for a taxable account. Now, you would, of course, want to consider the merits of municipal bonds as part of your overall bond allocation, but assuming they make sense and you plan to own some bonds in your taxable accounts, holding your municipal bonds there can be a good option. Well, that covers everything we wanted to touch on with our asset location discussion, and I know we went a bit more into the weeds than usual with this one, so hopefully we didn't lose too many people along the way, but this is one of those quote-unquote step 2 aspects of investing that's worth considering once you have the basics in place, because it's something that's in your control that has the potential to improve your after-tax investment return and ultimately leave more money in your pocket. And on that topic of investing basics, we have a podcast episode that covers them, episode number 5, the 80-20 rule of investing. So be sure to check that out if you haven't. That's a good starting point and introduction to investing. And if you want a deeper dive, we have a follow-on episode number 19, the other 20% of successful investing, where we dive a bit deeper into some of those next level strategies. But just to give a quick recap of some of the key points of asset location, number 1, there are 3 general types of investment accounts: Roth accounts, PreTax accounts, and taxable accounts, and each type is treated differently for tax purposes. So by knowing that, plus understanding that different types of investments have different characteristics and different levels of tax efficiency, within your one overall target investment allocation, you can be strategic about which investments you hold in which accounts, like a jigsaw puzzle, in order to reduce the drag from taxes over time and improve your after-tax investment return. This is known as asset location. Number 2, Roth accounts are accounts where money grows tax-free and you never have to pay taxes in the future when you withdraw it. Because of this, you want to hold your high-growth, tax-inefficient investments in your Roth accounts. A cardinal rule for asset location is to avoid owning bonds in your Roth accounts. Number 3, pre-tax accounts are accounts where the money grows tax-deferred, so you don't pay any taxes from year to year, but down the road when you eventually withdraw it, you pay taxes on each dollar you withdraw at ordinary income rates, which are higher than capital gains rates. Because of this, you want to hold your tax-inefficient investments that have lower expected returns compared to the ones you hold in your Roth accounts. The classic example here is bonds that pay taxable interest. And lastly, number 4, taxable accounts are accounts where you pay taxes on dividends and interest kicked off by your investments each year, and you pay taxes on the gains when you sell investments. If the investments are held for more than a year, you pay taxes on those gains at long-term capital gains rates, which are lower than ordinary income rates. Because of this, you want to own your high-growth, tax-efficient investments in taxable accounts. For example, U.S. large-cap index funds, growth stocks, and if you plan to own bonds in your taxable account, perhaps municipal bonds whose interest is tax-free. Well, thank you to everyone for joining us for another episode of the show. You can find the show notes at the podcast page of our website, mdwmllc.com/podcast, and we'll be sure to include in there the links to some of those prior episodes we mentioned. And if you have thoughts to share or questions you'd like to have answered, please feel free to shoot us an email at info@mdwmllc.com. Take care, everyone, and we'll look forward to talking to you again soon.
Want even more ideas, tools, and resources on how to make smart financial decisions? Check out the resources section of MD Wealth Management's website at mdwmllc.com, where you'll find additional knowledge and insight from Michigan physicians, including a blog, ebook, and one-page guides. While there, you can also schedule a 15-minute conversation with Andrew and Trent to learn more about what it means to work with the firm and how they serve physicians. If you've enjoyed the content, please leave a review on iTunes and share with your friends and colleagues. Thanks so much for listening. Andrew Mushbaugh and Trent DeBruin are certified financial planners, principals, and co-founders of MD Wealth Management, a registered investment advisory firm in the state of Michigan. All opinions shared in the show are for general information and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future returns. Please consult with your legal advisor, your tax advisor, or your financial advisor before making any decisions.